Loan approval is not magic, it's maths. And in this video, I'm going to teach you the exact maths banks use. How banks decided to give loans, risk, interest, or repayment ability. Have you ever wondered how banks decided whom to trust with money? Why does one person get a loan instantly and another gets rejected? Is it luck? Is it salary? Or is it CIBIL score? Today, we'll break down the entire loan approval system in the simplest way. By the end of this video, you'll understand exactly how banks judge you, how they calculate risk, how they fix interest, and how they decide whether you can repay the loan or not. How banks look at loan request. Banks don't give loans emotionally. They follow a fixed scientific step-by-step process. Whenever you apply for a loan, the bank checks three major things: your identity and history, your financial strength, the risk of giving you money. Let's break this down like a real life story. Imagine Ravi and Suresh both apply for a rupees 5 lakh personal loan. Ravi earns rupees 40,000 per month, Suresh earns rupees 40,000 per month. Both look the same financially, right? But one gets the loan and the other gets rejected. Why? Because banks don't only look at salary, they look at risk. Banks first check identity and history. KYC means banks confirm who are you, where do you live, what documents you provide. This is basic verification. CIBIL score means the report card of your financial behavior. Banks check your CIBIL like teachers check your exam mask. Score above 750 means safe, score below 650 means risky. It tells them, did you repay early loans on time? Did you miss EMIs? Do you have too much debt? Are you financially disciplined? If Ravi has a CIBIL score of 780 and Suresh has 600, the bank will immediately trust Ravi more. High CIBIL score is equals to high trust, low CIBIL is equal to high risk. How banks measure risk. This is the heart of today's topic. Banks check four types of risk. Credit risk. Will this person repay the loan or not? Indicators are CIBIL score, past loan behavior, existing EMIs, missed payments, credit card usage. If a person max out their credit card every month and pays minimum due only high risk customer. Income risk. Does this person earn enough to repay comfortably? Banks check says salary, type of job, government, private or self-employed, job stability, company reputation, average industry salary. For example, a government employee is considered low risk because income is stable. A freelancer might be considered medium risk because income varies. Repayment capacity FOIR means fixed obligation to income ratio. This means how much of your salary already goes in EMIs. For example, salary is rupees 40,000, EMIs already is rupees 20,000. FOIR is 50%. Bank usually want fixed obligation to income ratio under 40 to 45%. If FOIR is too high, loan will rejected even if your CIBIL is perfect. Loan purpose risk. Banks check why you need the loan. Home loan is low risk, gold loan is low risk, car loan is medium risk, personal loan is high risk, and business loan is very high risk. Why personal loans are risky? Because they have no security. Why home loan are safer? Because the house itself is the security. How banks decided interest rate. Interest rate is not fixed for everyone. Banks decide interest based on your risk profile. Low risk means low interest. High risk means high interest. For example, CIBIL 800 plus stable income is 10% interest. CIBIL 650 plus unstable job is 20% interest. Let's see secured versus unsecured loan. Secured loan. For example, home, gold, car. Interest is low. Why? Because the bank can recover money by selling the asset. Unsecured loan means, for example, personal loan, credit card loan. Interest is high. Why? Because there is no security. Let's see RBI guidelines and repo rate. When RBI reduces repo rate, bank loan rates usually go down. When RBI increases repo rate, bank loan rates increase. Banks follow this for interest pricing. Customer profile, age, job, repayment record. Banks check, are you young or close to retirement? Do you change jobs often? Do you have stable income? All these impact the interest rate. How banks test your repayment ability. Banks use multiple methods. Bank statement analysis. Banks check your last 6 months salary credit, cash withdrawals, gambling or span transaction, regular bounce charges, spending habits. If your statement shows financially disciplined, banks trust you more. Salary slips and ITR for self employed. To understand your real income, some people earn rupees 40,000 but spend rupees 39,000 every month. Some earn rupees 25,000 but save 10,000 every month. Banks want savers, not spenders. Employment stability. If you switch jobs frequently is risky. If you stay in a company long term is safe. Co-applicant. Adding husband or wife or parents increases approval chance. Why banks reject loans? Banks usually reject loans for these reasons: low CIBIL, insufficient income, too many existing EMIs, unstable job, high risk category, no proper documents, poor banking habits, loan purpose not clear, frequent loan inquiries, too many checks. Even one or two of these can reduce approval chances. How you can increase your loan approval chances? Maintain CIBIL above 750. Pay EMIs on time. Keep FOIR below 40%. Avoid too many loans. Show stable income. Don't apply for loans in too many banks. Improve savings habits. Avoid credit card minimum payment habit. Keep bank statements clean. No bounce charges. Banks don't just give loans, they study your entire financial life. They give money only after checking risk, repayment ability, and your financial behavior. Now that you understand this complete process, you can make smarter decisions, get better interest rates, and avoid loan rejection. If you found this video useful, like, share, and subscribe for more simple, clear financial knowledge. See you in the next video.